right, let's kickstart the show with a focus on a CNBC TV18 exclusive. Sources have told us that Insurer AXA may sell its entire stake in ICICI Lombard General Insurance. Now, my colleague Yash has been picking up all of that. He joins in with more details. Yash, over to you.
That's correct, Sonia. French insurer AXA Insurance is looking to sell its entire stake when it comes to the general insurance company ICICI Lombard General Insurance. What we've been given to understand from our sources is that AXA has floated a mandate and that is essentially to sell its around 3.8% stake which it holds in ICICI Lombard General Insurance. Do remember that this stake came to the company as a part of the share swap agreement which took place after ICICI Lombard decided to acquire and merge Bharti AXA General Insurance into itself. That's when under the share swap ratio, 3.8% approximately stake is what came to AXA as the shareholder of Bharti AXA General Insurance, and that is expected to be sold by the company. What we are also told by our sources that this transaction could be done in one or more tranches depending on the appetite. If the appetite is stronger, AXA could look at selling this entire stake in one go. Otherwise, it could take one or more tranches, and it will be done in the open market through a block deal. Now, just in terms of one number, AXA's stake as per the current CMP would be around 2,700 crore, and that would become essentially the block overhang which will lie on ICICI Lombard. We've written to both companies. ICICI Lombard has said that they have no comment to offer, and we are awaiting a reply from AXA Insurance.
Okay, all right, Yash. Thanks very much for that. So that's CNBC TV exclusive. But let's focus on the markets then. Devina Mehra, the chairperson and MD of First Global, now joins in to discuss all of the euphoria that we've seen. Devina, hi, welcome to the show. You know, I was reading one of your interviews around a month ago where you said that the small cap rally is actually nowhere close to the danger mark zone. And since then, we've only gained. I mean, we're at milestones for the Sensex and the Nifty. Would you probably advocate a little bit of caution at these levels now?
Yeah, hi. I mean, good to be in the reverse of a men-only panel that one sees more usually. So it's good to be in an all-woman show. So coming to your question, see, the overall, we talk about this lake of returns theory that the lake overflows, or rather a danger of a bear market comes when the returns have been far higher than trend. Not just small cap. I was looking at the Sensex because it went past its 40-year mark some time ago. And I was looking at some data which was for each decade. So 1980 to 1990 to 2000, 2000 to 2010, 2010 to 2020. And the numbers were like, I think 21% in the first decade and 17 and 14% in the next two decades. And 2010 to 20 was some 8 and odd percent. So that decade actually was far, far below trend. So this whole movement that you saw from the last year's COVID lows, it's still not taken you even to the trend line, which is why, you know, my opinion has been that there is not any great danger of a big bear market, and which is true not just of the broad market. If you look at the small caps, again, pretty much the same story. But I always say that small caps, even when you say bullish, it is always cautiously bullish because it is a risky end of the market, and it's a risky end of the market, not just in India, but practically anywhere in the world. I was looking at the US data, it's pretty much the same. There was some data showing that small cap mutual funds in the US outperformed over the long term. But once you adjusted for the funds which had gone out of business or had merged with other funds, essentially, you know, adjusted for the survivorship bias, you find that they had not really outperformed. So we are always risk averse, we are cautious. So even when we like the small cap space, we don't go all out to buy it because we have many strict parameters on liquidity, etc. So if I look at our PMS schemes, we have less than 10% or around 10% in small caps. Small cap defined as below 5,000 crores market cap. So we remain cautious there. But as I said, on a market as a whole, given the history of returns, we are not really in danger territory if you look at rolling returns, because still beginning of 2020, there was a very long period when you had not even met fixed deposit returns. And for 5 years, in fact, you had not even met savings deposit rates. So there was that room which had been created for the market to go up.
Okay. Devina, hi, morning. You were saying that you're glad to be a part of the all-woman team in front of the camera. We have a woman director as well rolling the show. So we have a woman sitting behind the camera too. And our producer is also a woman. So it's clearly women power, this morning. So
and why not?
Why not, of course. No gender biases here. But anyway, so you said that there's no real risk of a bear market or, there's no real risk of a big derailing of this market right now. What does one do then? Do you continue to invest? And if yes, which are the pockets where there is still growth potential and valuations are still not, sky high?
So let me just, temper that by saying that when I say no big risk of a big bear market, doesn't mean that there cannot be significant corrections, because in any move, there can be significant corrections. And if you look at India, it is not as if that we have no macro concerns. You still have a lot of things not quite okay on the economy front with citizens and therefore consumers suffering. And there is, of course, because of the commodity prices going up, there's been pressure on margins also in certain segments. You just spoke of consumer durables, even FMCG to some extent is facing similar things with an inability to necessarily pass on the price hike. So it's not that it's like a risk-free zone. And, I can tell you the way we manage funds, as I said, our whole approach is to be cautious, which means that we are fairly diversified. We don't take outsized sector bets. So that's part of the story. And actually, if I look at the top weights, it's not changed a whole lot. I mean, we still have chemicals fairly high up. IT is probably the highest, even, it's not outsized, but it is the highest. And not just IT services, but certain other segments of technology. Because this was a trade that we identified last year, when FMCGs were the flavor of the season. And I said that this is another industry where you have fairly stable prospects, decent margins, returns, but the valuations were a fraction of what FMCGs used to trade at. So there has been some re-rating. Plus, it's a dollar hedge. It's more predictable. So all those things. So that was a nice space to be in. We did play the commodity play from third quarter onwards last year, but we cut back quite significantly after having made quite substantial money in that, especially steel, because non-ferrous, there is still room. Steel, I think, will be like not bad, but no longer great. So that's been the broad outlook.
Devina, a little short on time today, but I really want to ask you this. What do you say is the color of the money that's coming in? I mean, a lot of the investors that are with First Global, for instance, I mean, is it a different profile, more younger people, if at all? And what would you say to a whole generation of first-time investors who've not really seen a brutal bear market yet?
Yeah, be cautious. As I tweeted recently, don't confuse a bull market with brains. So don't attribute all your success to how smart you are, because the bull market will make you look better than you are. And yes, I mean, it's good that younger people are getting interested. We get a lot of messages asking for products for smaller investors. So we are just about to, in matter of 2 to 3 weeks, we'll be launching on the small case platform. So that is something that the younger and newer investors can look forward to. And as all those statistics on compounding show that the sooner you start, the better off you are at the end of your when you retire or whenever you hang up your boots, which is a good thing. So even if you start 5 or 10 years later, you need a far higher rate of compounding to get to your retirement corpus.
Okay, Devina, it's been a pleasure, but I completely take your point. You cannot mistake a bull market with brains. Thanks very much for joining in and talking to us. We'll take a short break now, but we'll get chatting with Shashwat Goenka, who's the sector head of retail and FMCG at the Sanjeev Goenka Group, on their foray into the personal care segment on the other side. Stay tuned.